Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 23rd July. Coming up on the show, the US and Japan agree a trade deal. The president labels it massive as the tariff is set at 15%. But the Detroit Three, that's Ford, General Motors and Stellantis, aren't too thrilled. I'll explain why. And earnings season continues. We'll have the latest from the likes of AT&T, Hasbro and Hilton. So grab your coffee and let's own the morning. Well, we kick off the things you need to know before the opening bell rings on Wall Street by taking a look at where US stock futures stand. And it isn't really a surprise that we've got green across the board. This expected open comes after Asian and European stocks rose on the back of the trade deal that the US and Japan struck. And that's our first thing you need to know before the opening bell rings. So the deal means that the US will impose 15% tariffs on goods imported into America from Japan. Now, that is lower than the 25% the president had threatened in a letter earlier this month, but higher than the 10% rate that had been in force while the countries negotiated. Japan will also invest $550 billion into the US. The president said Japan will open its markets to American cars and rice. These had been sticking points during the negotiations. However, steel and aluminium tariffs of 50% as well as defence spending commitments aren't included in the deal. It's not the only deal, though, that's been struck in the past 24 hours. Earlier on Tuesday, a deal was struck with the Philippines, which will see the country's imports face a 19% tariff into the US. The president said that US exports will face no import tax in the Philippines as part of the deal. And a deal has also been struck with Indonesia. Yahoo Finance's Ben Werschel has reported that a 19% tariff will apply to Indonesian goods. Now, the next thing you need to know is still related to the deal with Japan. We're talking about cars. Japan's Prime Minister Shigeru Ishiba said that auto tariffs had been reduced from 25% to 15%, and this is the key thing, without any quota or numbers of imports. Just take a look at how some of Japan's biggest car stocks performed overnight. Toyota leading the way there, up over 14%, as you can see. But a group representing the Detroit Three, that's General Motors, Ford and Chrysler parent Stellantis, raised concerns about the Japan trade deal. Why? Well, it leaves tariff imports from Canada and Mexico at 25%. And a spokesman for the group said that any deal that charges a lower tariff for Japanese imports with virtually no US content than the tariff imposed on North American-built vehicles with high US content is a bad deal for US industry and US auto workers. Meanwhile, shares in major European car makers, well, they rose. They rose on the back of their Asian rivals, which also rose, on hopes that a similar agreement with Europe can also be reached. The German car makers, as you can see, all up there. Europe shipped cars worth just shy of $39 billion last year. That's more than 4 times as many in the other direction. And that leads us nicely onto the last thing you need to know before the opening bell. Now, so far, Japan is the largest country to strike a deal with the US. It is, in fact, the world's 4th largest economy. So who could be next to strike a deal? And why are those investors buying European car stocks right to be so optimistic? Well, earlier this week, we were talking about the EU preparing countermeasures against the US if no deal is struck. As things stand, the White House will impose a 30% levy on EU imports on August the 1st if no deal is struck. Relations between the EU and the US, well, they're not exactly at a high point after the president has repeatedly accused the EU of unfair trading practices. Also, it's worth noting that EU leaders will be meeting with China on Thursday. European Commission President Ursula von der Leyen will be meeting President Xi. Now, according to reports, one country that doesn't look like it will get a trade deal by August the 1st is India. Agriculture seems to be a sticking point here. However, India is set to strike a trade deal with the UK later today. Now, apart from trade deals, earnings are dominating investor sentiment, and there are some big names after the closing bell today. And my colleague, Josh Lipton, well, he's got the details for you.
Time now for what to watch Wednesday, July 23rd. Starting off on the earnings front, huge day of earnings with some heavy hitters on deck Wednesday, including Alphabet and Tesla. Taking a look at Alphabet, the Google parent company, reporting second quarter earnings after the markets close. Investors keeping a close eye on AI investments that may push up the company's capital expenditures. Ad prices and the cloud business also in focus for Alphabet, with analysts anticipating Google Cloud to grow around 27% in the quarter. Shifting gears to Tesla, Tesla also announced the results for the second quarter after the closing bell. Analysts expecting Elon Musk's company to meet estimates for Q2. That's driven by stronger sales of the updated Model Y, but the recent rollback of EV tax credits under President Trump's big beautiful bill could pose challenges for Tesla going forward. And closing in on the housing market, we're going to be getting existing home sales data on Wednesday. Economists forecast that number to fall slightly in June to an annualized pace of 4 million, meaning fewer previously owned homes were sold in June compared to May.
Time for market movers now, and again our focus is on earnings. We start with telecoms giant AT&T. Its revenue came in at $30.8 billion. That's against expectations of around $30.4 billion. Earnings per share came in at 54 cents. The prediction was for 52 cents. These results are slightly better than expected, and they look solid following an impressive recovery from a slow start to 2025. Now, AT&T stock is on a good run, outperforming both its rivals and the broader market. That's probably down to its budget-friendly plans and strong fiber presence. Growth in fiber broadband is clearly a big focus point for the firm. AT&T stock is up over 20% this year. The S&P 500 is up roughly 7%. Now, it's worth remembering that AT&T's Q1 results suggested that its cheaper plans were luring customers away from rivals, and analysts on the whole were positive on the deal AT&T struck to buy Lumen Residential fiber broadband networks as well. Okay, let's move on to Hasbro. It's the maker of toys, everything from My Little Pony to Transformers, and it's just released second quarter results as well. Revenue in Q2 came in at $980.8 million. That's against expectations of roughly $880.5 million. Adjusted earnings per share, well, that came in at $1.30. The expectation was for just 77 cents. Now, Hasbro is known for consistently beating earnings estimates. Its previous two quarterly results beat the street by an average of 38%. So another handy beat this time round as well. And listen to what the CFO of the firm had to say. She said, despite a dynamic macro environment, the strength of our diversified business and cost productivity initiatives support our updated outlook. And the stock price, well, that's been pretty impressive too, up just under 40% this year so far. And it's trading higher in pre-market, so there's no surprise there too. And finally, let's look at Hilton. It's got results out just now, and the hotel chain posted Q2 revenues of $3.14 billion. The street had predicted revenue of around $3.1 billion. Earnings per share came in at $2.17. That's versus expectations of $2.04. So that is a rise in revenue, but by not as much as the same period last year when revenues jumped by over 10%, but still better than expected. Heading into earnings, analysts who cover Hilton had started to become more and more bearish on the hotel giant. There were actually 6 downward revisions in the last month or so. But that's not really reflected in the share price. It's up over 10% this year. And in fact, over the last 3 months, Hilton shares are up around a quarter. But in pre-market, shares are down, and they are down quite sharply. Why? Well, Hilton has cut its net income forecast for the rest of 2025, as it says that travel demand looks set to decline. Okay, well, it's time for a quick break now. We'll be back with some great insights on Tesla. Okay, let's jump over to my colleague Jared Blickery, who brings us some great analysis on what to expect from Tesla earnings.
Tesla reports earnings after the close on Wednesday, and on today's Stocks in Translation, I'm going to be breaking down the historical market reactions in the stock as well as the options market, and we're going to begin with a look at what would have happened if you had bought just before earnings on each of the reporting days going all the way back to 2010 and then holding for various periods here. And this is going to show you what happened 1 day later, 1 week later, if you're holding 1 month, 1 quarter, and 1 year. And by the way, these are median returns returns. And so 15 years of history here. And then these, the white here is the percentage of times that it was positive. So just as an example, I'm going to circle the 1 day. The median return there is actually negative 0.7. And then that's only positive about half of the time. And a very similar return for a week later. So statistically, you're really not doing much there. Then at a month, you turn positive with a little bit better odds, but only slightly, 52%. And then at 1 quarter, you finally get up to about 60% with median returns of 2.4%. Just in general, I like to look for at least 70% returns for a good odd, and that's just because stocks tend to go up. So we finally get that at the 1 year holding period where we have median returns of 20.2% with an average positivity rate or a positivity rate of 71%. And now I'm going to show you what happens with 1 year holdings. So if you go all the way back to 2010 after earning or right before every earnings announcement and you held for 1 year, these would be the 1 year returns. And I've blended these. It's a 2.5 year or 10 period moving average. So you can see how in 2014 this peaked at almost 200%. Then it just climbed to above zero, slightly positive. Then we got above 200% in the wake of the pandemic. Then we dipped negative very slightly there in late 2023, and we are now again positive. All this put together just kind of tells you that you're probably better off, unless you're extremely nimble, holding for longer periods of time, at least 1 year or more. And then I want to get into some of the stats that we're seeing with today's or tomorrow's options, tomorrow's options implied volatility. And first, I'm going to break this down for you. So options implied volatility measures investors' expectations of future price swings based on options prices. And here we have that number all the way to the left here. Options implied volatility, 10.7%. So options traders are expecting the Wednesday close and then the announcement. So Wednesday close to Thursday, that range would be 10.7%. And it doesn't tell you if it's going to be up or down, just the range. And then here's what happened over the last 2.5 years. The actual reaction was about 12.8%. So this tells us that options traders are expecting a little bit less volatility than we've seen over the last 2.5 years on average. And finally, in this column here, I have the average daily movement on non-earnings days since the last announcements, and that is 5%. So that is less than half of what the options traders are expecting the move to be, and even less so when you measure it against the actual reactions over the last 2.5 years. So all of this tells you we are definitely expecting some volatility tomorrow. I want to close here by just showing you what Tesla stock has done recently in relation to the other Mag 7. And in fact, I have some other mega cap names in here as well, including Berkshire Hathaway and Eli Lilly. I'm going to put, this is what's happening today. I'm going to show you since the April 8th bottom, and we can see some pretty impressive returns here. If this populates, we're going to see a lot of green. There's Nvidia in the upper left, up 75% since then. And here's Tesla, up 50%. And then if we measure it, and well, it looks like the chart is going to do what it wants to. Let me just pull up a chart here of Tesla, and I'll show you the year-to-date price action. It does tend to be a very volatile stock. So again, if you're nimble, that's great, and you can trade this, wonderful, but probably a better long-term hold for most investors here. And you can see the stock is down about 18% year-to-date, still in a trading range basically over the last few months. Tune in to Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
As always, smart analysis there from Jared. Now it's time for another break, but hang around for our trending tickers and the return of meme stocks. Welcome back, and first up, donut. And I'm not talking about breakfast here, but about Krispy Kreme, which might be the latest meme stock you need to watch out for. Krispy Kreme was mentioned by famous subreddit Wall Street Bets, and shares were up again, more than 25% in pre-market this morning, up 27% in pre-market this morning, after jumping nearly 27% on Tuesday. So you might be wondering what's fueling the rally. Well, that's a good question. There isn't any major good news for Krispy Kreme regarding its fundamentals or strategy. But the stock has been battered after its breakup with McDonald's 3 weeks ago, and now some retail traders and Redditors seem to think it looks cheap. Okay, our second trending ticker is Texas Instrument. This one is looking deep in the red, with Texas falling more than 11% in pre-market trading. Actually now just over 10% in pre-market trading. That's after chip makers' third quarter guidance disappointed against expectations. Texas Instruments posted a 16% rise in second quarter revenue to $4.45 billion and forecasts at least the same number for the third quarter. However, the average analyst estimate, according to Bloomberg, was higher at $4.57 billion. Now, the CEO of the company mentioned disruptions from tariffs and geopolitics and said, quote, "We are prepared to navigate as things evolve." Okay, finally, let's look at Europe's most valuable companies and one of the continent's leaders in artificial intelligence. Software giant SAP, well, it's fallen more than 4% today after it posted mixed second quarter results. Total revenue for the second quarter was up 9% at 9.03 billion euros. Overall, the report was positive, but many analysts pointed out that SAP did not raise its guidance despite beating expectations for this quarter, highlighting how the company still looks quite conservative compared to what many American investors are looking for. So even if it's leading in some AI segments, SAP is striking a cautious note, also given all the uncertainty from tariffs and ongoing trade negotiations. And as you can see, the trading there down 3.5% roughly today. Okay, now we want to zoom in on a digital payments and blockchain company that's caught investors' attention in recent months. Many expected the crypto company to benefit from a favorable environment for the industry in the United States, and yet Compass Point just downgraded Circle, or CRCL, to sell. So what's happened there, and what does it mean for your next trade? Well, Yahoo Finance senior reporter Inez Ferre joined our very own Julie Hyman to take a closer look at what's making Wall Street so divided on the stock.
We're looking at Circle. It's sliding after getting a downgrade to sell from neutral at Compass Point. That firm citing more competition for Circle with the passage of the Genius Act. Here with more details, senior markets reporter Inez Ferre. And obviously, hi Inez, obviously Circle has, had a big run here, but there have been some skeptics that come out more recently.
Yeah, that's right, Julie. And we saw that big run, the catalyst, because of the Genius Act that was just signed into law on Friday. So that's been very bullish for the stock. But now Ed Engel over at Compass Point is saying, look, usually investors tend to sell the news around big events. So he expects a sort of retracement when it comes to this rally on the stock, which is up more than 500% from its IPO price on June 5th. But he's saying two things here. He says one is that he believes that this company is overvalued at this point, because he's saying that as the stablecoin issuer continues to expand its distribution, it will be making deals which will require it to share more of its interest income the way it does, for example, with Coinbase. So that's one point. The other one that he's making is that on the heels of this Genius Act, you are going to see fintech with more competition in the stablecoin space. So you will be having competing stablecoins out there. And that is a point that Wall Street has been making in recent weeks. But make no mistake, Wall Street is divided on this, because you have 9 buys on this stock, you have 6 hold and 4 sell. You just had Seaport Research last week, which raised its price target to $280. Keeping its buy on the stock, saying that the Genius Act is a watershed moment for the stablecoin industry, and they see Circle as a purist play when it comes to stablecoins.
So as Mag 7 earnings kick off today, there's one question on everyone's mind. Is it time to buy Alphabet stock? That's the parent of Google. That's because if you compare it to other big tech stocks, it actually looks relatively cheap. It's trading at 23 times its earnings per share compared to Nvidia's PE of 53.6. And yet, look at this chart. Despite a big rebound in recent months, Google Alphabet is still in the red for the year. Why is that? Well, investors have expressed a series of concerns. First and foremost, legal and regulatory scrutiny in the US, in Europe, and elsewhere. Plus, many investors have been worried about growing competition from the likes of ChatGPT and Perplexity AI. But if you look at the business fundamentals, the long-term prospects here remain pretty solid across Alphabet's staggering portfolio of giants. YouTube, Waymo, Google Search and Google Cloud are all growing their user base. Gemini is now bringing increasingly relevant AI responses to many of us when we search online. Even though there are challenges like the ups and downs of the advertising market, Google's double-digit growth is expected to continue in Q2, especially as it integrates more and more AI tools into its ecosystem. A couple of numbers here. AI overviews. That's AI summary you now get at the top of your searches attracted, get this, 1.5 billion monthly users. YouTube Music and Premium now boast more than 125 million global users, and that's expected to be a major driver of recurring revenue. Google Cloud delivered revenue of $12.3 billion. It's a 28% increase year over year. Beyond revenue, Alphabet's profitability is also expected to improve. And keep in mind, Alphabet has consistently surpassed analyst expectations. It's been beating estimates for 4 straight quarters now. Just last quarter, it posted a 39.1% earnings beat. Well, with these numbers, we're not surprised to hear so many analysts being very bullish about Alphabet. Okay, now let's take another look at the markets to see how the latest trade news and those earnings reports are impacting trading this morning. Here's what European markets are looking like right now. And as you can see, everything in the green following that trade deal with Japan and the optimism perhaps that there could be a deal in the offing for Europe as well. See there, the CAC 40 up almost 1%. And let's have a quick look at how US futures are Asian traded, how it closed. Asian trade closed all higher as well. The Nikkei in particular was particularly bullish. And let's have a quick look at US futures as well if we can. And they're all set for the green too. I should note that AT&T, the company that I mentioned earlier with the results beat, well, despite that beat, shares in pre-market are trading down there. You see there, down 3.3%. So keep an eye on that one. A bit of a surprise there that they're trading that much lower, despite the earnings beat as well. Okay, well, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up at 9 a.m. Eastern, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.